Well, bond traders are turning their focus now to this week's crucial US inflation data after Friday's jobs numbers fell short of expectations. Joining us now to discuss his latest investment strategies is Schroder Investment's head of Asia Fixed Income and Portfolio Manager Rajeev de Mello with us in Singapore. Rajeev, great to have you. To the non-farm numbers being a bit of a miss and also this week's inflation numbers, how much does that kind of change the narrative for you in terms of what the Fed does this year?
Well, I think that the Fed should be quite happy with those non-farm payroll numbers. Jobs growth were strong enough to confirm the recovery in the economy, and there wasn't any acceleration in any of the inflation worries either. And in terms of the unemployment rate, it was roughly what the Fed had told us to expect when they published their dots in December. That doesn't put any pressure on the Fed to accelerate its pace of hikes, but it doesn't take away any hike probability either. So I think we're pretty much on this course. We expect about 3 hikes this year, which is the same as what we had last year, and it's still very gradual for the Fed.
Does it jeopardize the GDP growth target, though?
Not really. I think average hourly earnings did tick up a bit, so that's pretty good. Participation rates is stabilized as well. With this type of employment, which is positive, and the other signs that we're seeing on the economy, which are generally quite positive, we're going to have the impact of the tax reform coming in as well. So I don't think that it jeopardizes the growth. If anything, we should see a pickup in growth, precisely due to the implementation of the tax reform, which was signed in at the last end of December.
Rajeev, looking at your research, you like Indonesian and Indian bonds. Do you like them in a local currency, or do you like the dollar-denominated versions?
I like them in the local currency format. I think that in this environment, these higher yielders will do well. And why is that? I mean, generally, the dollar is probably slightly on its weakish course. We usually look at the dollar and say, oh, interest rates are going up in the U.S., so that means the dollar should be stronger. But actually, growth is the main determinant, and relative growth is the main determinant of currencies. And while the U.S. is growing okay, other countries are catching up, and that's keeping the dollar a bit on the sidelines. And countries which have higher yields, such as Indonesia, such as India, I think will be favored by emerging markets and global investors who have started the year increasing their allocation to these growth-sensitive parts of the world.
It's interesting also that you're of this belief that central banks will allow a degree of overheating, but they won't admit it. Why?
Well, I think that they have seen that they are quite competent when it comes to bringing inflation down. But they did get that scare over the last 6-7 years since the global financial crisis, that it was very difficult for them to address when inflation was too low. So I have a feeling that in the central bank community, the Fed, the ECB and the BOJ, they will be more tolerant of slightly higher inflation. But at the same time, they don't want to admit it because they don't want to scare markets that inflation is out of control, and they're not targeting inflation as closely as they were in the past, especially if inflation starts to rise. They don't want a bond sell-off. They don't want higher yields choking off a recovery. So that's where they'll be very cautious. But they will allow inflation to go up a bit, I think, a bit more. And that was sort of signaled in many speeches by many of these central bank governors, notably Janet Yellen last year. And I think that Jay Powell will continue this policy as well.
When do you see this reassertion in inflation and also the reassertion of things like the Phillips curve being, still relevant after last year was really a year of questioning whether these kind of ideas that we have when it comes to price pressures are still working?
Yes, I mean, the Phillips curve is a trade-off between a low unemployment rate and that putting pressure on inflation up. And that didn't work. We had a low unemployment rate and inflation didn't react at all. And there were certainly some big structural factors like demographics and technology which impacted that. But I don't believe, and we don't believe, that the Phillips curve is dead. We just believe that probably you need lower levels of unemployment to generate some higher inflation. And we've seen that that average hourly earnings number in the U.S. did tick up a bit, and we'll probably see some of that wage increase continue this year. And that will bring back the discussion on the Phillips curve and lead to somewhat higher inflation as well in the course of this year. But it is much more gradual than it has been in the past, and that's what's been surprising to a lot of people.